So we'll be going over Chapter 9 today. That's long-term and fixed assets. Um, we'll be going over the classification of fixed assets, what costs get capitalized into fixed assets, and then how to calculate various depreciation methods, what gets depreciated, what goes into determining how we're going to depreciate an asset over the useful life to spread. Basically, we're just spreading the cost of these large purchases over the amount of time that we're using them. And then all the necessary journal entries needed, including depletion of natural resources, think timber, oil fields, that kind of thing. And also intangibles like patents, copyrights, and goodwill, which is called amortization. And also illustrating the fixed asset turnover ratio to show the efficiency of the company's use of fixed assets. And then some presentation things on the balance sheet. So fixed assets are long-term, relatively permanent assets that a business is going to use over a long time, like machinery, buildings, and land. And the difference between an investment and a fixed asset is a fixed asset is generally used in the operations of the business. Think an office building, a factory, some machinery, cars for the business. Whereas an investment would be something like buying a bond or other financial assets or an investment in another company. So fixed assets are tangible, so they exist physically. Something like a patent would be an intangible asset because it doesn't exist physically. It's just a piece of paper that says a company owns this intellectual property. Fixed assets would be more like land, buildings, equipment. And they are owned by the company and they're not inventory. They're not offered for sale. Think about John Deere. John Deere sells tractors, and the tractors to John Deere are inventory, but to a farm company, it would be a fixed asset because the tractor is used by the farm. But um, so it depends on how the business um, uses the asset as well. And yeah, they really are critical to the business. And a cost that's incurred by the business can be classified as a fixed asset, an investment, or an expense. So think about a company purchasing something. If they're purchasing a tractor for use in the business, that would be a fixed asset. If they're purchasing a bond or another type of investment, that would be an investment. And then if they're purchasing rent or supplies or something else that's going to be used up immediately, and then as that's used, that's expensed. And fixed assets over the life of the business. So business do get used up. And then we have to do what's called depreciation on those, which we'll get into later. But step one is the purchase long-lived? If not, it goes and used up as an expense. And if it is long-term, then is it an asset that it's used in normal operations? If not, then it's an investment. And if yes, then it's a fixed asset. And even under the no category of expenses, that would include inventory, that would include prepaid expenses. Those do get capitalized as inventory, as prepaid insurance, as prepaid rent, but they're all used up. Mostly they're current assets, right? So they get used up within the current year, and that's why we're just kind of lumping them into as an expense. But fixed assets and investments are more the long-term assets of the business. And there's a number of costs associated with fixed assets and getting them into place and ready for use. So only costs that are preparing the fixed asset for its intended use are included in the cost of the asset. And if they don't increase the asset's usefulness, then they're just an expense. For example, these are some examples of things that are not capitalized into the initial cost of the asset. You remember when we make the journal entry for purchasing a fixed asset, we would debit equipment and then credit cash. What goes into that equipment balance is the purchase price of the equipment, the sales tax, the freight, the installation, any assembly cost, any testing to get it ready. But things that are not included would be if vandalism happens, that's just an expense for the current period. That's not any cost to fix vandalism that's like happening. That's not a cost that's going to make it better. General repairs to a machine are expensed in the current period. They don't make it better for the future, so to speak. Mistakes in installation, uninsured theft, damage during unpacking and installing, and fines for not obtaining proper permits. These do not get capitalized. They're an expense in the current period. It can be tempting for businesses to capitalize them because they want to spread the cost out over a longer period of time, but they are related to the current period. And so for different categories of our fixed assets, building, equipment, and land, there's a number of different things that can be capitalized as a part of them. And then land improvements is another thing. So land, we never depreciate land because there's a finite amount of land. And so the value of it isn't said to decrease over time, but there is a number of items to get land ready for its intended use that we capitalize as a part of land. So the purchase price of the land, sales tax on the land, permitting, broker's commission, title fees, surveying fees. So the people that come out, they have lasers and they can level the ground, and any delinquent real estate taxes, which is sometimes if a piece of land is very behind on property taxes, the county would seize it and then sell it for the cost of the property taxes, or there's a lien or a contingency on a property that's, if you buy it, you have to pay the back taxes on it before it's sort of legal. So that would be included in the cost of the land. And then removing any unwanted buildings, less any salvage, that's important. If we're, as a business, if we're buying a plot of land with a condemned building on it or something that has to be removed, when we're thinking about buying this land, and there's like two equal plots of lands, right? One without a building and then one with this condemned building on it, the cost to remove that condemned building is sort of an implied cost that needs to be capitalized as part of the land, because that's getting the land ready for its intended use. But that wouldn't, and then the building cost would be the architect fees, the engineer fees, the insurance, and all this costs to capitalize the building would be included with the building, but getting the land ready to just be a piece of land ready for the business, that all gets capitalized as part of land. Land improvements would be shrubs, fences, outdoor lighting, paved parking areas, sidewalks. That's probably the biggest land improvement category. And then so there's a lot of costs, and it really is just classifying it to different of these categories, and it's important to classify it properly because each of these items has a different depreciation useful life. Land, we don't depreciate at all. Buildings depreciate over quite a long period of time. It's whatever the expected useful life of the building is. generally 20 to 30 years maybe. And then machinery and equipment, maybe 5 to 7 years. Land improvements, it depends on the land improvement, but probably 10 to 15 years. If you think about like the useful life of a parking lot or something like that. So it's important to classify it so that our capitalization of the asset is accurate, and then our future depreciation is also accurate. Does anyone have any questions on this? Because I know there's a lot of different categories and um, um, it'll come up kind of like this, where it'll say freight costs were, the equipment was 12,000, the freight cost was 600, the installation was 1,500. It might come up on there are multiple choice or like drop down questions where it says, this is the type of purchase, what kind of asset, what kind of fixed asset is it? Is this land? Is it land improvements? Is it equipment? And then something like this on in the problem here, $500 was due to an error in installation. So we would have to know that we don't include that $500 in the equipment capitalization because that was just a mistake that happened. And so that could consider that a repair. A repair is an expense in the current period as opposed to so that like that's how this would be applied in the homework, I guess. Does that answer? Okay, cool. So in this example, we have Kimball Inc. purchased equipment for $12,000 and freight costs of $600 were incurred to transport the equipment to the installation site. So that would be included because it's getting the asset ready for its intended use. And then on-site installation costs were $1,500, including $500 due to an error in installation. So we add the $1,500 and subtract the $500 because that was included in the $1,500, and we get $13,600 and cash $13,600. And then separately, we would include it for that $500. That would be repairs and maintenance expense, $500, and then cash, $500. That would be where this $500 would go. It would be expensed in the current period. It would show up on the income statement as opposed to these expenses show up on the balance sheet. And our statement of cash flows, it shows up in the investment section of the statement of cash flows. And when building a new building, company incurs direct costs such as labor and materials, and if the building isn't done by the end of the period, it goes into what's called construction in progress, or CIP. And then when the construction is complete, we credit construction in progress and we debit buildings because now it's ready and it's ready to get depreciated. Construction in progress is not depreciated because it's not being used up yet. And then there's also leasing of fixed assets, which is similar to renting. I mean, I think we're all familiar with like leasing a car. This is like, so computers, automobiles, medical equipment, buildings, airplanes are really commonly leased. And the lessor is the party that owns the asset, and the lessee is the party that is renting or leasing the asset and is getting to use the asset under the contract. And the lessee pays the lessor rent on a periodic basis over the term. There's a specific term. And it allows companies to not have to pay the entire upfront cost of the asset, not have to secure a whole bunch of other extra debt. Think about like airlines leasing airplanes is super common because it's really hard to raise enough money to buy a new airplane for $36 to $60 million from Boeing, right? That's insane. And so being able to pay the cash as the asset's being used, it's a big advantage for businesses. And then in the contract, it really is all sort of divided who's responsible for maintenance and repair costs. There might be like an ending value that's required. Think for cars, there might be mileage restrictions and then paying costs for extra miles. Um, and then there's also, right, if it becomes obsolete before the end of its useful life, um, if the asset is going to have to be replaced in 5 years, leasing it for that time can be less risky by the business, and more risky by the business lending it. It's like, what is the value going to be, and who's going to be left holding the bag for that? And related to leasing, there were some new accounting standards released recently. Recently is a very loose term that in the last 20 years, there were new accounting standards released on leasing, and it distinguishes between finance and operating leases. A finance lease treats it much more like a debt transaction. Think if a company is leasing an airplane for almost the entirety of the airplane's life, gets to purchase it at the end of the period, and bears all the responsibility for the maintenance of the airplane, that's equivalently the same as the company going out, borrowing money, and purchasing the airplane outright. They effectively own the asset, and so then that could be capitalized as a finance lease. If they're leasing an asset for a year, 12 months or less, or a very short period of time, not the entire life of the asset. Think leasing a computer for 12 months or something. That would be a rent expense and crediting cash. The finance leases, they're required to capitalize the lease on the balance sheet. It creates what's called a right of use asset, and then they also capitalize the cost of the debt associated. It's something to know. I really don't think we're going to go into this any more than that. But basically, finance leasing is more debt equivalent. Operating leasing is more rent equivalent. Think like renting for 12 months or less. Finance leasing there's an obligation for the next 10 years to be paying on a lease, and the lessor or the business renting the asset is really on the hook for the majority of the asset. It's not going to be worth much at the end. And the cost of leasing is like if we add up all the payments on the lease, it's materially equivalent to actually just buying and paying a loan on the asset. So I don't mean to beat a dead horse on this, but yeah. Does anyone have any questions about that? I know that there's a lot on this. Melinda owns ABC Print Company and incurred the following costs in acquiring 2 printing presses. One printing press was new, the other was used. And so we have to indicate which costs should be for the new and which costs should be for the used asset. So for the new asset, we're capitalizing the fee paid to the factory representative, right? Because if it's a new asset, it's going to come from the factory representative. That's not related to the used asset. There is no factory rep involved. The freight, the insurance in transit, the sales tax on purchase price, and the special foundation for the new asset, not included the parts used to replace the damaged parts from the unloading process. And for the used, we're including everything except for the repairs incurred in reconditioning the press and the vandalism repairs during the installation. And the costs that we do include, right, freight, installation, repairs of the worn out parts, fees paid to the attorney, review the purchase agreement. These costs are all directly related to placing it into service. 10 and 12 are damage that's happened in the current period, and we're just repairing that damage. That's not regular wear and tear. That's something bad happened, and we just need to repair and maintain the asset as opposed to like reconditioning it, like the replacement of worn out parts when buying a used asset. Now, we're also going to determine the cost of the land. They constructed a new warehouse. They paid $60,000 in cash, $100,000 in a short-term note. They also paid $1,250 in delinquent taxes, $10,000 to remove an old building, and $8,000 to remove the old building. The taxes were $10,000, and the materials salvaged from the building were sold for $1,500. So that's going to be taken away from the net, I guess, the net salvage cost. And the contractor was then paid $415,000 to construct the new warehouse. So determine the cost of the land to be reported on the balance sheet. So right, we're going to take 60,000 plus the 100,000. That's sort of the cash and debt consideration that we gave. And then legal fees of $1,250. And then we add that 10,000 for the taxes, 8,000 for the salvage, subtract 1,500. And for the land that was sold, and then we get $177,750 is our cost of the land that's going to be on the balance sheet, and that $415,000 is going to be displayed as buildings, because that's the cost of the building. And then that'll be depreciated as buildings, where the cost of this land will not be depreciated. It'll just sit on the balance sheet at this balance until it's sold, basically. And when accounting for depreciation, we have to spread the expense related to the fixed assets over their useful life. And it's called depreciation expense. Land has an unlimited life. It's not depreciated, in case I haven't said that enough today. And depreciation is caused by a number of factors. Physical depreciation is the wear and tear on the asset just due to exposure, due to use, things breaking. And then the functional depreciation is obsolescence, changing customers' need, things that cause the asset to no longer be useful. And thinking about a computer. Part of the depreciation on the computer is me breaking my USB ports, the keyboard sort of wearing out, everything getting scratched, right? That reduces the value of the computer. The functional depreciation is that computers 3 years from now are going to be way better than computers today. And so a computer, like the computer is no longer useful like a 5-year-old computer, especially a laptop or especially 10 years old, is not useful. It doesn't have enough storage, doesn't have enough processing, fails to load Windows. And so it's not worth as much. And we need to reflect that in our expense. And it does not measure the decline in market value of the fixed asset. It's measuring our allocation of the cost over the asset's useful life. Thinking about a car, right? When you drive the car off the lot, it loses 20% of its value. It depreciates 20% of its value. We don't depreciate the car 20% the day we take it off the lot. We allocate the car's depreciation over its useful life. And we have to determine whether the method that we use, whether it's based on usage of miles, years, and then how that gets allocated. But whether or not it's equal to the fair value of the car is irrelevant. We're just trying to match, using the matching principle, our revenues to our expenses. And when we're using the car, it's being used to create revenue. The book value of the fixed asset is the cost minus the accumulated depreciation. It doesn't necessarily need to align with the market value. However, we do try to track it, generally speaking, track the market value. Another good example is buildings. If we have a real estate business, we buy a house, start renting the house out to renters, the value of the real estate is probably increasing over the 30 years that we're depreciating this building. But after 30 years, the building is going to be on our books at a book value of whatever we assign, either zero or whatever we assign a salvage value at. But the building's value has probably increased. There probably needs some renovation, things like that. But the actual value of a building, the value of a house after 30 years is not nothing. In fact, it's probably more than it was originally, but we still need to depreciate it over 30 years or whatever we decide the useful life is because we need to match the costs to our revenues. And depreciation does not provide cash to replace fixed assets as they wear out. It's a non-cash expense. It doesn't provide cash. It doesn't create cash. Yeah. So factors for computing depreciation expense. We have the initial cost, the expected useful life, and the estimated residual value of the asset. So the initial cost, right? That's all the costs that we were calculating, not for land, but for everything else. And then the residual value is what do we expect this to be worth at the end of its life? I think my Xbox One S probably sell it for $50 right now. I think that's about as low as it's going to get, but I think that that would be the residual value, right? Like that's sort of, and then useful life is just how many years that we're expected to be used in normal operations. And residual value could also be referred to as scrap value, salvage value, or trade-in value. And the depreciable cost is the gap between the initial cost and the residual value. So I bought my Xbox for probably $300 or $400. The residual value is $50. Then the depreciable cost is $350. That's that gap between the initial and the salvage. And then we allocate that over the life of the asset. And there's a number of ways to do this. And we'll go over a few of those. So for example, this asset, $24,000 initial cost, 5-year expected life, residual value of $2,000. The depreciable cost would be $22,000. And we have to allocate that expense over 5 years. And we can do that using straight line, units of activity depreciation, or double declining balance depreciation. And Under straight line depreciation, the cost is going to be equal in each of the 5 years. So $22,000, I think it'd be like 2,000, it'll be 4,200 over the, maybe 2,400. It'd be equally 22,000 divided by 5. That would be straight line, equal cost every year. Units of activity would be like depreciating a car based on the miles. So we expect this car to last 100,000 miles. We're just going to divide the depreciable cost by 100,000 miles. The miles that we use on the car, that's our depreciation expense every year. Double declining balance is a little bit more complicated. We'll go into it in a moment, but it lumps the majority of the depreciation expense earlier in the life of the asset as opposed to later. So depreciation expense can be higher in year 1, less in year 5. And it's not necessary for a company to use only one method of computing depreciation. Companies have an entire fixed asset listing. They list all their assets and they're divided into all the types of assets: equipment, buildings, cars, land improvements. And they have usually a written policy saying we're depreciating our equipment over 7 years, our cars over 5 years, our buildings over 27 years, and our land improvements over 15 years. And we have a different depreciation method for each because we think it's the most accurate, and we can divide it based on what asset class it is. We can do whatever method is the most appropriate. So for this asset, 22,000 divided by 5 is 4,400. And that will be the cost every year. We just debit depreciation expense, credit accumulated depreciation as an adjusting entry at the end of each year. Right, so under straight line method, 20% gets depreciated every single year. And common mistake would be dividing the 24,000 by 5. But at the end of the useful life, we need to have $2,000 left over in the value of the asset. So we need to subtract 24,000 by 2,000 to arrive at our depreciable cost before we divide by 5. So that's really important trip up that I see. And computing the straight line depreciation can be simplified by calculating a straight line percentage. So dividing 100% by 5 is 20%. And so we can multiply the initial cost or the initial depreciable cost by 20%, and we get our depreciation over 5 years. 25 years, 100% divided by 25 is 4%. So if we want to calculate the cost every year, we multiply the depreciable cost by 4%, and we get our annual depreciation. And then we record our expense as follows, with a debit to depreciation expense, credit to accumulated depreciation. It's December 31st because it's an adjusting entry at the end of the period. And accumulated depreciation is a contra account, much like allowance for doubtful accounts, right? It shows up in the asset section of the balance sheet, and it shows us our net book value of our fixed assets. And as the life of the business, life of the asset progresses, the net book value on the balance sheet.
So with like just the first year of purchasing a new item, like say you bought the forklift in September at the
Yeah.
end of the year for the depreciation, would you do it only X amount of months worth of depreciation and then just do the full year the next time?
Yes.
Okay.
You're just ahead of me. So yeah, the question is like, do we, if the expense is purchased if the asset's purchased and placed into use mid-year, yes, we allocate it based on the number of months. And also, if we're preparing quarterly financial statements, we also have to allocate the depreciation throughout the period. And important to note when we're looking at the costs of placing an asset into service, for example, a building, all this construction in progress, and like preparing the asset for use. We don't start depreciating the asset until it is placed into use. So if we purchase the forklift in July, but it takes a few months to get here, and then we have to spend like a month repairing it to place it into service, we only actually start depreciating it when we start using it on the floor of the warehouse. Perfect. Great question. And then, yeah, this is assuming that the asset was placed into use on January 1st. This is the net book value at the end of each year. And so end of the first year, we have 19,600. And then at the end of the fifth year, we have 2,000. And it would still show up on our balance sheet if we separate the initial cost and the accumulated depreciation, then the initial cost would still say 24,000, accumulated depreciation 22,000, and then we'd have a subtotal net book value of $2,000. So under the units of activity method, we depreciate the asset by the same amount for each unit of activity, and it can be hours, miles driven, quantity produced. For airplanes, I've seen it as like pressurization cycles, really like the jet airliners, things that they are depreciated based on hours of use and miles flown, but the main thing that makes an airliner less useful, especially for short journey flights, is the pressurization when it gets up to altitude. The amount of cycles are limited on the fuselage. So there can be any method that we deem appropriate for units of activity that we can measure, we can allocate based on that. And it can also be referred to as units of production or units of output method. And to calculate, we have to take the cost, subtract the residual value, and divide it by the total estimated units of activity. So the forklift, we're estimating it based on the activity level using units of activity and based on the number of hours. And looks like we're estimating this to be used for about 10,000 hours. And we just divide 24,000, we divide the $22,000 depreciable cost by the number of hours. Yeah, by the 10,000. And then we get, right, 2,000 hours would be 4,400 because that's, and then, right, less hours in year two means that we have our expenses lower in year two. I like this method. It makes sense to my brain. But yeah, see, so the expense is different in each year, and then the amount that the net book value goes down is also different in each year, based on the activity. And then the double declining balance method. So this combines elements of the straight line method, but then we want to put more of the cost at the beginning of the period than at the end of the period. And so we determine the double declining balance rate by multiplying the straight line rate. Remember when we took the 100% divided by 5 years is 20%. For double declining balance, we'd use 40%. And then we compute the depreciation expense by multiplying the double declining balance rate times the book value of the asset. And so we take 24,000 multiplied by 40% is 9,600 in the first year. And then in the second year, we take the 24,000 minus the 9,600 and we get our beginning book value for the asset. We multiply by 40% and we get 5,700. And then each year our depreciation gets less because we're taking 40% of a smaller amount. It's called double declining balance because we're taking double the rate, 40% instead of 20%. And then declining balance, we keep taking it as a percentage of this declining balance. And then as soon as the key thing to note as well is we can never go below our salvage value. So as soon as we hit $2,000, we have to stop. So in this fifth year, the cost is only 1,110 because that's the remaining depreciable cost. Yeah. So once again, it's an accelerated depreciation method to account for a higher amount of the depreciation in the first year of the asset's use. And if we were placing this asset into use mid-year, for this first year, say that we placed it into use on July 1st, we would divide this amount by 2 because it was only half the year. If we placed it into service October 1st, we would divide it by 4, right? Because it was in use for 25% of the year, this 9,600. And then in the following year, we would take the net book value on January 1st, multiply it by 40%. And that would arrive at our amount. And the depreciation method chosen is really whatever most accurately reflects the use of value of an asset. Like how is the depreciation happening? And when we're calculating the double declining balance method, the estimated residual value is not considered when multiplying the 24,000 by the 40%, right? We're not doing 22,000, it's 24,000 times 40%. And then we can finally consider it at the end. We just can't go below our residual net book value. So this one is definitely the trickiest method, but with practice and just sort of having the formula written out as you for your reference, it doesn't have to be super intimidating. And so over the life of the asset, we have sort of exponentially less depreciation throughout the period. And then the majority of the asset gets depreciated in the first year and then less so in the future years. And so for calculating the depreciation method, this is a great cheat sheet here. The depreciable cost is the cost for a straight line cost less residual value. Calculating the straight line rate is just taking the years, 100% divided by the years of use. Units of activity, we take the cost less residual value, and we divide it by the total units of activity. And then we multiply our units of activity times our rate. For double declining balance, we take the declining book value, which is not consider our depreciable, like that doesn't consider the cost less residual value, right? It's just the total book value less accumulated depreciation multiplied by the straight line rate times 2, and that's double declining balance. And it won't show up in this course, but you could think if we got creative, we could do triple declining balance and we just take it multiplied by 3, or we could take it multiplied by 1.5. There's a lot of methods to create a policy, but the key for double declining balance, that's taking the straight line percentage rate multiplied by 2 times the net book value at the beginning of the period. And depreciation expense is constant for straight line. It's variable based on use for units of activity, and then double declining balance, it just slowly declines as the asset is used. And all 3 methods allocate a portion of the total cost of the asset to an accounting period while never depreciating an asset below its residual value. So a fun math thing that I think is interesting to note, if we did actually take the net book value, if we multiplied this 40% multiplied by our amortized, like our depreciable base, right? If we multiplied 22,000 instead of 24,000 by 40%, we would never reach $2,000. If you think about, if you've ever heard of the riddle, it's like if someone always gets halfway to where they're going, and they're always getting halfway, they'll never actually make it to the finish line, right? Because if we just keep on dividing by 2, eventually we'll just be dividing by pennies, but we'll never actually reach 2,000 if we're just, or say the depreciable cost was 0, or if the salvage value was 0 under this method, we would never reach 0 because 40% times a non-zero number will never be 0. So that's not, I guess, required knowledge, but it's an interesting way to think about it, right? So sorry to nerd out on you. It's not a math class, but for partial year depreciation, we generally prorate the depreciation based on the first day of the month. So, for example, if we purchase something on September 10th, we're going to assume that the asset was placed into service, or if we place it into service on September 10th, for calculation purposes, we're assuming it was placed into service on the 1st. And if we purchased it on the 20th, then we'd assume it's on the 1st of October, right? Because we're just to simplify our calculation, we're not going granular to the day here on what day was this placed into service. We're rounding to the nearest month. I think for tax purposes, it rounds to the nearest 15th of the month, which is interesting, but don't quote me on that. I would have to look up the guidance. And under straight line method, depreciation is prorated based on the number of months the asset's in service. So if the asset was placed into service on October 1st. We have 3 months left in the year. So we would multiply it by 3 divided by 12, right? So we get the monthly rate, multiply it by 3, so to speak. We're allocating that first year depreciation. So it's only a quarter of the year. We're only depreciating a quarter of the straight line rate. And then in the final year, we're going to have 9 months of depreciation. There's going to be another year on the back side of this because we used it like September 30th, 5 years from the initial date is going to be when it's fully depreciated. And just because an asset is fully depreciated doesn't mean it has to be sold. It could be what's called fully depreciated, still in use. We're not taking depreciation expense on the forklift anymore, but we're still using it. It still works. Just because it reaches the end of its life doesn't mean it has to not be used anymore, right? If there's so assume that the forklift was used for 400 hours and it was placed into service October 1st. So for the units of activity method, we don't really care what day it was placed into service. We just care how much time it was used or how many miles it was driven. And in this case, our hourly rate is $2.20 an hour times 400. We get $880 as our depreciation expense. And a double declining balance is the same. We have to allocate it based on the amount of the year that the asset was in service. So if we place it into service year 1, we take 100% divided by 5 is 20%, times 2 is 40%. That's our double declining rate. Then we multiply 24,000 by 40%, we get 9,600, and we take 9,600, divide by 12, multiply by 3 months, and our rate is $2,400 for the first year. And then in the following year, we use our new net book value, 24,000 minus 2,400, and then we multiply by the full year, 40%. So the second year depreciation then is 21,600 times 40% is 8,640 under the double declining balance method. And we don't stop until we hit a salvage value of 2,000. So we just continue over the years. And estimates of the residual value of the fixed assets may change due to abnormal wear and tear or obsolescence. And when new estimates are made, they're used to determine the depreciation expense in future periods. The depreciation in earlier periods is not affected. Accounting, we're always estimating things in accounting, and we can't just go back every time an estimate was wrong and restate the previous year's financial statements. That would create chaos, similar to allowance for doubtful accounts. If more accounts this year are written off than we thought, we can't go back to last year and change the bad debt expense. It just has to be sort of updated going forward. But we make the best estimate that we have at the time, and we can't go back and change the past. And so we have to, going forward, change the depreciation method. So under this example, we'll go through some examples here. Changes couldn't involve, we could change our estimate of the useful life. We could change our estimate of the salvage value. And we would just have to recalculate what the depreciation expense is going to be going forward. Based on our depreciable cost, based on the new useful life, based on the new salvage value, we would change what our new calculated depreciation is. And if an asset is severely impaired, we could write off that as a one-time expense, but this is more revising. This example here is more related to revising the useful life. So initial machine cost of 140,000 and estimated residual value of 10,000 and a 5-year useful life. So our annual cost is $26,000. At the end of the second year, the net book value is $88,000. So we had 26,000 divided by $26,000 over 2 years. We had 52,000 in depreciation. So that's our accumulated depreciation balance. And then we have our book value. And we initially estimated it at 5 years, but now we're estimating that the machine's remaining useful life is 8 years. So tricky word problem moment. The remaining useful life is 8 years, which means instead of 3, the total useful life would be the 10 years, right? Because the beginning of the, I hope that makes sense. The beginning of the period, it was 5 years. Now 2 years have passed. We're saying the remaining useful life is 8 years. If they said the total useful life was 10 years, it'd be the same. And then the remaining residual value is 8,000 instead of 10,000. And the depreciation expense for each of the remaining 8 years is $10,000. So when we change our estimate of what the annual depreciation cost is, we take our net book value minus the salvage value, so we get $80,000. That's our new depreciable cost. And then we divide it by the revised remaining useful life. So we don't care that the total useful life was 10 years. The remaining useful life is 8 years. And so our annual cost is now $10,000. And the expense changes. So initially, we were depreciating it 5 years. So the slope would end up, this graph isn't even accurate. That's annoying. But initially, it would go to 5 years, right? Now it's going to spread all the way out to 10 total years of life, because in year 2, we estimated that it's going to last longer. So our depreciation cost changes from 26,000 to 10,000 per year. And then once a fixed asset has been acquired and placed into service, the costs may be incurred for ordinary repairs and maintenance. And a cost that benefits only the current period are called revenue expenditures. A cost that it improves the asset for its extended useful life is a capital expenditure. Purchasing the asset initially would be a capital expenditure. People are always talking about their, CapEx this year was that that means capital expenditures, and it's the investments in property, plant, and equipment for the future. A really good example of this is, and one that I've worked on, is an oil refinery. Corrosion is a huge thing in an oil refinery, and stuff has to be repaired and replaced all the time. New valves, new safety things. And if something has to be replaced every 3 months or even every year, that's an expected ordinary expense to generate revenue this year. And so the company has to allocate that cost to this year as a repairs and maintenance expense. They can't capitalize that into the 20-year useful life of the oil refinery. And then a really common thing in oil refineries too, it's called a turnaround. It really is just a major maintenance that happens every 5 years or so. In an oil refinery, they have to shut it down for like a month or so and then do a huge amount of maintenance. Think of a whole bunch of really grimy people trashing the hotels of the town for an entire month. And it's a huge endeavor, and it costs a lot of money. And then that major turnaround could then be depreciated over another 5 years, because they know every 5 years we're going to have to do this. It's extending the useful life. We know how much this turnaround improvement is going to cost. We're going to expense it over a period of time. And so, and there has been instances of fraud in the accounting world of companies capitalizing expenses that shouldn't be. Capitalizing repairs and maintenance expense reduces the expense, increases net income in the current year, and then it divides out the repair cost over the next 5 years, but that's not fair or accurate. We need to have that in the current year. So ordinary repairs and maintenance is recorded as an expense for the current period. Think debit repairs and maintenance expense, credit cash. So just for a tune-up of the delivery truck, that's very clearly in the current year. Oil change, whatever. After a fixed asset has been placed into service, costs may be incurred to extend the asset's useful life. The engine of a forklift near the end of its useful life may be overhauled at a cost of $4,000, and it extends the useful life by 8 years. Initially, we thought it was only going to last 5 years. Now we're doing this large cost. And in the case of the forklift, the expenditure is recorded as follows. It's a credit to accumulated depreciation forklift, and then a debit, a debit to accumulated depreciation and a credit to cash. Think about this as now our depreciable base has once again grown. So it says near the end of its useful life. So we could assume that this is in year 5. The cost of the asset's basically at 2,000, the salvage value. Now we're debiting accumulated depreciation. So now our net book value is 6,500, and we can start depreciating it again over 8 years because our estimate of the useful life has changed. So we have to use the formula back here to estimate the new useful life, estimate the new costs, the new net book value, and then we can, in this case, if it was near the end of its useful life, then the net book value would jump, and then we'd start depreciating it again, right? So. And asset improvements are also possible. For example, adding a hydraulic lift for 5,500 to allow for easier, quicker loading of cargo. This is the capital expenditure that would increase the initial cost of the delivery truck. Think about the difference. Extraordinary repairs is a debit to accumulated depreciation. An asset improvement, like this extraordinary repair, it's not adding anything new to the forklift. It's still just a forklift. But this asset improvement, adding a new loading dock or hydraulic lift to the delivery truck, that's a new thing related to this delivery truck. So we're debiting delivery truck and then crediting cash. Does that difference make sense? Great. So cost related to a fixed asset benefits only the current period. That's repairs and maintenance. If it benefits the current and future period, and it's an extraordinary repair, just extending the useful life, then it's debit to accumulated depreciation. And if it's an asset improvement, it adds service value, it's something new to the asset, then it would be a debit to the fixed asset itself. I'll let you guys calculate this one. So we have a machine, it costs $65,000, residual value is $3,000, and we have a $10,000 useful life. What is the depreciation in year 2 under the double declining balance method? So I'll let you guys work this out yourselves, and then I'll also do it sort of on the board here. So we have 60, this is the double declining balance method. So we take 100 divided by 10 years, and we get 10%. And we multiply 10% times 2. We get 20% per year of depreciation. Then we're going to multiply the total cost, not the depreciable cost, the total cost by 20%. So 65,000 times 20%. Does anybody tell me what this is? 50? 13, okay. So $13,000. And then our new net book value is 52,000. Perfect. And then the following year, we're going to multiply by another 20%. And our depreciation in the next year, perfect. So I think with that, that's all I have for you guys today. We'll continue with fixed assets on Thursday, some more examples, but thanks everyone.